And I have the pleasure of introducing Manuel Montes, who will be providing our presentation today. Manuel Montes works for the Latino Community Credit Union as a financial analyst and investment specialist. Manuel is responsible for providing the finance department with a variety of reports that help the organization track financial performance. He also collaborates with different departments to help prepare financial analysis for grant applications, institutional depositors, and credit union regulation agencies. Prior to working at the Latino Community Credit Union, Manuel worked as business and financial analyst at various companies within different capacities, including corporate treasury, commercial renewable energy, and account payable auditing. Manuel graduated from UNC Chapel Hill with a Bachelor of Science in Business Administration in 2013. He is a native of Medellin, Colombia, and he moved to the United States at a young age and grew up in Kernersville, North Carolina, and now lives in Raleigh, North Carolina. And I want to thank Manuel and the Latino Credit Union for your willingness to share your expertise with our students today. So Manuel, the floor is all yours.
Excellent, Juana. Thank you so much for your introduction. And thank you to the College Foundation of North Carolina for providing us with this opportunity. And, for today, I'm pleased to have this presentation. We're going to be covering a presentation that we would like to call the steps to being financially fit after graduation. We're going to cover 4 areas of financial fitness and success after graduation. We're going to cover building your savings, creating a budget, establishing credit. What is credit and why is it important? And we'll also talk a little bit about what we should think about when we pick the right financial institution. So let's first begin with the fundamentals, building your savings. Like most things in life, the management of our finances is much easier to navigate if we create goals for ourselves. And a good way to start is by establishing your savings goals. We're going to talk a little bit about what those goals can be, and we're also going to cover what kinds of financial tools and what kinds of savings accounts are available for you to accomplish these goals. So, savings goals will vary for every individual, but it's typically common knowledge and common practice to have what we call an emergency savings fund. An emergency savings fund is a savings amount that should provide you with anywhere between 3 to 6 months worth of expenses in the event of an unexpected loss of employment or a medical injury. This is one of the most fundamental keys to ensuring that your financial fitness is protected should an emergency occur. A new computer is another example of a savings goal that you can have and work towards. The down payment for a new car, the down payment for a house or a mortgage, as well as a future retirement. All of these things are savings goals that would help you determine what kind of money you need to be putting away in order to reach them. I'd like to share a quote that says, as we begin to discuss this concept of needs versus wants, which is critical, that says, the richest man is not he who has the most, but he who needs the least. I wanted to share this because it really captures the concept behind needs versus wants, as well as the sequence of priorities that should govern your savings goals and your financial decisions. Your savings strategy will be most effective in dealing with potential financial hardships if what you have saved for ensures that you have covered critical and central needs in your life, more so than things that will provide you with instant gratification. So, when identifying your savings goals, know the difference between your needs and your wants. A computer that stores all of the essential programs that you might need to write formal letters on Microsoft Word, track expenses and perform calculations on Excel, or prepare presentations on PowerPoint, or simply store critical information and documents that you need in your life, like your insurance policy, your tax documents, your bank loans. A computer that provides your needs, and your needs, more importantly, will always be your best bet over a computer that has that and a lot more. There are differences, for example, in the capabilities between, say, a $350 PC on your left and a $3,000 Mac on your right. Often, a big chunk of what you're paying for with that $3,000 golden Mac that's on the right is really that little Apple logo that's on the center of that Mac, right? And the oohs and ahs that people might see and appreciate from having that Google Mac. But beyond that, a Google Mac, an Apple Mac computer or a PC, they provide you with the same fundamental capabilities. Vehicles, another great example of needs versus wants. Like, for example, did you guys know that Mark Zuckerberg, owner of Facebook, who has a net worth of more than $50 billion, drives an Acura TX, which is just a $30,000 vehicle? Larry Page, co-founder of Google, who has a net worth of more than $77 billion, drives a Toyota Prius. The fact that these billionaires choose to purchase modestly when it comes to vehicles is not something that is random. They could easily afford the Ferraris, the Bugattis, the latest Mercedes, but they choose simplicity. A car gets them from point A to point B, and they need nothing more. This is, again, a critical piece to think about as you uh, uh, prepare your savings goals, and you prepare them around your needs versus your wants. So, different kinds of savings goals that you can prepare for. You can create a framework around your savings goals based on a timeline of things to accomplish. You have short-term goals, which are goals that you can complete within 1 year. This will depend on your level of income, but examples include an emergency savings fund, a new computer, the down payment for a car loan. There are medium-term goals, for example. These are the kinds of goals that can be completed between 1 and 5 years. One such example is the down payment for a mortgage loan. And then you have long-term goals. These are the kinds of goals that are usually greater than 5 years, such as preparing for retirement, or preparing an education fund for your children, or even the costs of starting your own business. So we've discussed savings goals and different ways of looking at them. We've discussed needs versus wants, as well as savings goals in the context of a timeline. Here are some of the tools, some of the accounts that you can use that are at your disposal within the financial markets for you to accomplish them. You have a traditional savings account, which I think most people are probably familiar with. Um, this is an account that you open at your local bank or credit union, where you're able to deposit money into. By depositing money into this account, the bank appreciates that and rewards that in the form of an interest payment to you. If you look close enough at any checking accounts that you might have for any of you, you'll notice that every month you might receive a few pennies uh, into the balance of that account. Those pennies represent the interest payment that you are receiving for depositing your money into that account. This kind of account is best for short-term goals. Further up the tier of accounts, you have what is known as a money market account. This account rewards you with a higher interest rate, but that interest rate also entails that you cannot pull your money in and out with the same ease, or what we call the same level of liquidity. With a money market account, you usually have to have a minimum balance in that account. At the Latino Community Credit Union, for example, in our money market accounts, the balance cannot go below $500. They would, at an institution such as ours, we would want you to, sure, you can pull your money in and out, but you must have at least $500 into your account. In return, the institution will pay you a higher interest rate. This is another great account for short-term goals. As you move further up the ladder, you can start looking at things like certificates of deposit or term certificates. These offer some of the highest interest rates for savings accounts, like the money market account. It requires a minimum balance, usually higher. Again, that's due to the fact that they're paying a higher interest. And now, in terms of liquidity, you can't say deposit or withdraw with the same ease that you typically have with a money market account or with a traditional savings account. You have to maintain the same balance for a specified period of time, uh, or a designated term, um, before you can actually access that money. So liquidity is lower, but the interest is significantly higher. And this is the type of account that is great for medium and long-term goals. Last but definitely not least, you guys will hear about this when you graduate. You have specialty accounts for retirement and education. By this point, maybe you're seeing, right, a pattern. A bank will take your money and they will pay an interest rate on that money, and they will be willing to pay that a higher and a higher interest rate, so long as you're willing to have less and less liquidity. A retirement account is the kind of account where you receive the highest possible interest rates, and you have even tax benefits. These tax benefits and high interest rates are designed to ensure that that money is increasing as much as possible on a month to month and year to year basis. And they're designed so that you can achieve your long-term goals of either retiring or of having the necessary funds in an education fund to pay for your children's college. Before I keep going, I wanted to also, assuming this is okay with you, Juana, people are more than welcome to post questions on the chat, and we can address them towards the end of the presentation.
Yep,
I will.
that works fine.
Awesome. Okay, we can do that so that it's as engaging as possible. Um, but yes, these are the vehicles that you can use: traditional savings accounts, money market accounts, certificates of deposit, specialty accounts, retirement accounts, and education funds. All of them have different interest rates and different liquidity options, um, depending on what your goals are. So, a, a fundamental principle that all people should sort of understand when it comes to financial fitness is that at the end of the day, it doesn't matter how much money you make, but rather how much you're able to save that truly counts. And to display that, let's go through a simple exercise in comparison. You have two people. The person on the left makes $42,000 a year, which is a reasonable and good salary. And then on the right, you have, your doctors, your lawyers, your corporates who are making $150,000 a year, a significantly higher amount of money on an annual basis that one would deem would lead them to a much more financially stable future. But the facts are that in the case of, our doctors and lawyers on the right who are making a lot of money, which could be you, could very well be you after you graduate. If, say, you're making, again, $150,000 a year, which translates to about $11,000 a month that's coming in, you could very well have a mortgage, right? That is $4,500 a month, loans that are $3,500 a month. You might be spending $2,500 in entertainment and $1,000 in who knows what else. You add up all those expenses, and if they are higher than your annual income, you will be left over with a negative balance or with a deficit on a month-to-month basis. With an annual income of 42,000, which translates to $3,500 after tax on a monthly net basis, you could have a modest house, a modest mortgage where you're paying $1,200 a month, loans that costs you $550 a month, an entertainment budget that is a fraction of what of what Mr. Doctor or Mr. Lawyer is making with $275 a month, and just about the same amount of money spent on other expenses like food, um, anything else that you can think of, and you are left over with a $475 surplus, a savings that positions you in a much better position than someone who's significantly spending money. So, big takeaway here is that it's not how much you make that truly counts, it's how much you save on a month to month basis that truly matters. So, savings. After graduation, I think most people will run into um, financial gurus, financial advisors, financial representatives who will provide complex theories and thoughts on what is the best way to be financially fit. But here's a very simple takeaway from one of the most renowned financial investors in the world who professes that savings is fundamental, right? Do not save what is left after spending. Instead, spend what is left after saving. That comes directly from Warren Buffett, who is worth more than $79 billion today and is deemed the Oracle of Omaha, one of the most successful financial gurus of our age. So that's savings, right? It's something important, and it's truly about developing the right discipline and the right habits, so that before you know it, as time is ticking away and the years are going by, you're not worrying about your financial fitness because you are doing what's necessary to ensure that you have enough. Next, I want to discuss creating a budget, which is the next big piece to learn throughout this presentation. The benefits of creating a budget are simple but profound, right? They allow you to take control of your expenses. They allow you to prepare for planned and unplanned expenses. They allow you to reduce the amount of money that you may need to borrow from other people and other institutions. And they are a fundamental piece to preparing your savings goals and achieving them. What is it that you need to create a budget? It's simple, but it can be, somewhat tedious. You need to know what's coming in. You need to know how much you're bringing in from your full-time job, your part-time jobs, your short-term gigs. You need to have a good sense of what your income might be. Just as importantly, you need to have, probably more importantly, a good understanding, a good sense of how much money is coming out. What are the expenses that you are incurring on a month-to-month basis on food, on clothes, on bills, and other purchases? How much do you owe to credit cards, to other people, on loans, your auto loans, your mortgages? And what are your savings goals? Again, what would you like to have at the end of a year? How much money would you like to have to purchase that new laptop, to purchase that new vehicle, or eventually to have sufficient enough money to retire? So we're gonna go through the arithmetic of creating a budget. It starts with recording your income and expenses. What sources of information are at your disposal to start seeing this? You can hold on to your receipts. You can either on an Excel spreadsheet or on a notebook note how much money you're spending, and you can keep track of this on a month-to-month basis, so that even though the numbers might change from month to month, you start getting a better sense on a monthly basis of how much money is coming in and how much money is coming out. These days, there's even more advanced ways to do this. You have, if you guys Google applications that track your expenses, there's even applications out there that will link directly to your bank account and that will track exactly what you're spending and what you are achieving, what you are bringing from your job, from your income. So beyond understanding how much is coming in and how much is coming out, particularly when it comes to money that is coming out, it's good to begin categorizing them and classifying them. And you'll see pretty soon why that can then be beneficial. And then again, not rocket science. The basic math here is to subtract what you're spending against what you are, um, what you're bringing in terms of revenue. So we'll start with a very basic example. Let's say you are making $1,300 a month. That's coming in every month from your job, or from or from multiple jobs, but ideally from your income. And then in terms of evaluating your expenses, this is where you begin to break down and classify how much money is going into each different aspect category of your life. On groceries, you're spending $110, utilities, $150, entertainment looks like a $400 expenditure on a monthly basis, which is can be quite high. Gasoline, $70, your phone bill, $45. And what you would like to save on a monthly basis, let's say that that's $100 with then rent to $500. This is a very, again, basic but practical and useful set of categories that you can cater to as you're developing your budget. And then once you add up all those expenses, let's say you're looking at a number that looks like 1,375. It's at that point that you should have an aha moment, right? I'm spending more than what I'm bringing in. That should be an aha moment, and that should be a moment where, as you're looking at your budget, you begin to strategically determine where it is that you can cut costs. Where you can do that and how you can do that is contingent on how you classified all of those expenses. So you can start going through groceries, utilities, entertainment, gas, and start seeing, okay, where can I cut costs? Okay, maybe I can turn my thermostat down during the summers and save a little bit of money on my utility bill. That $400 a month expense is looking mighty high. Maybe I need to, cut down the concerts to see Kendrick Lamar, or maybe I need to reconsider what it is that I'm doing entertainment wise, and find the best way to cut that cost down to say $250, right? And by just doing that, you might see yourself in the green again, simply by understanding, again, where is my money going? How is my money being spent, and where can I best control it? By doing that, you can position yourself so that rather than spending $1,375, all of a sudden you're looking at $1,185 a month in expenditures. Before I continue, just want to check in on the chat here, just to make sure I'm not ignoring any potential things.
I don't see any questions so far.
Okay.
No
Okay.
questions.
Excellent. So we'll continue. That's budgeting, guys. This it's the exercise of understanding how much money's coming in, how much money is going out, and how much money you would like to be going out. And it can be done, and this can be done by just about anybody. So, moving forward, the small stuff adds up. This is something that that is, again, a simple concept, but that is tremendously profound. Let's suppose that every Monday through Friday, that you like to have a small cup of coffee from your favorite coffee shop that costs $3.78. At a first glance, what are $3.78? Nothing, right? But then the law of the numbers never fail. As soon as you start adding that up on a weekly basis, that looks like 18 bucks, 19 bucks just about. On a monthly basis, now that looks like a $75.60 expenditure. I looked up most recently Netflix prices a month, and a Netflix premium account is about it's about $18 a month. So basically what this is telling me is that these cups of coffee every day from Monday through Friday are equivalent to just about 4 premium Netflix accounts. And so by looking at the numbers this way, you can start cross-referencing and cross-comparing against other goods that you pay money for and start reevaluating the worth of certain expenditures. On a yearly basis, that looks like $907, almost $1,000 that are coming out of your account, of your savings account on a yearly basis, simply by going through the habit of spending $3.78 a day. That is profound. And this is the kind of thing that is within the control. It is within the realm of possibility for someone to control in order to make a deep impact on their financial fitness. So we've discussed savings, we've discussed budgeting. Now let's talk about credit, what it is and why it's so important. What is credit? Credit is the ability to obtain goods or services before paying for them. In exchange, you pay extra charges known as interests, in addition to the cost of the good itself. The most common forms of credit are credit cards and loans. If you have credit, you may have debt. This means that you owe money to a person or an entity that lent you money in the past. Many people in the US have applied for loans through financial institutions like banks or credit unions. And when a person makes a loan payment, these payments are recorded so that a person's payment history and behavior can be reviewed by potential lenders in the future. This is called a credit history. Having a good credit history can help you pay less interest when you apply for loans. Alternatively, having a poor credit history can make it more difficult for you to acquire loans, and you will likely have to pay higher interest rates on those loans that are available to you. We'll discuss this further and show some numbers around why it's important. Let's talk about debt now for a second, because debt and credit, and more specifically, debt and credit scores go hand in hand. There's different types of debt. You have investment debt. This is when you borrow money to pay for something that will increase in value over time, like a house. Oftentimes, the price of houses will increase over time, and you can sell your house for more than what you bought it for. Other examples of investment that include student loans or loans for home improvements. Just about anything where you borrow money, pay for a good, and that good has the potential to create some sort of return later down the road. This is a very important kind of debt, and as you progress in your financial savviness, this is the kind of debt that you can truly make money work for you. You have convenience debt, which is more practical debt. It's the kind of debt that is used to buy expensive things and pay for them over time. For example, an auto loan is an example of convenience debt. Instead of paying for the car all at once, you pay a little bit each month. You'll have to pay interest in exchange for the convenience of this kind of loan, but you will be able to drive a car in return. Another example, using your credit card to pay an unseen medical bill or an unforeseen auto repair. So convenience debt is critical because it provides you the means to resolve any immediate financial purchases that are big in a certain amount, and it doesn't require you to have to pay those large amounts immediately. It buys you time so that you can pay those amounts little by little as time goes on. If you're careful, it can be very good for you. If you know your budget and your future monthly payments, you can position yourself so that you get rid of this debt as soon as possible. Last but not least, you have consumer debt. Consumer debt is a good instance of it is when you use your credit card to pay for things on a daily basis, like again, like the cups of coffee, or going to the grocery store, or paying for entertainment expenses. It's somewhat similar to convenience debt in that you're not using your own money to pay for these goods. You're using someone else's money, but in lower amounts. This is the kind of debt that you don't want to keep around too much, or let grow beyond your control, because the interest on it can be quite high, and the consequences can be negative as a result of that. So these are the kinds of debts that are typically at your disposal. Credit cards. Often people confuse credit cards with debit cards, right? But here are the main differences. A debit card is really no different than a check. It's just plastic. Every time you swipe your debit card, uh, say you purchase a pair of headphones at Walmart, just as an example, it costs you 20 bucks. Well, actually, that's quite expensive for some headphones. Let's say it's actually maybe not so much. Let's say it's $20. Those $20 come directly out of your bank account. That's what a debit card does. Is it uses your own money. It works like a check, but it works much faster. A credit card is different. Credit card allows you to buy things now and pay for them later using someone else's money, using the bank's money, using the financial institution of your choice, and using money that they allow you to use. This means that the money that you use will be owed to that company at some point in time, typically at the end of the month. So as you're using your credit card and that credit card's balance is increasing, what you have to ensure is that at the end of the month that you pay that full balance. Otherwise, you likely will be charged a fee on top of that balance that you already owe, as well as that fee's called an interest charge, which is typically pretty high, anywhere between 13 to 14%, depending on the institution which gives you that credit card. But credit cards are not bad. Again, they provide you the means to um, make purchases and pay them later down the road. And they are good things to have. They also build your credit, which is critical in order for you to have access to other financial loans. So how does one go about how does one begin to build their credit? From the beginning, typically it's through a credit card. More specifically, it's through a secured credit card. With a secured credit card, what you have is, what a bank will ask you to do is to deposit a certain amount of money into your savings account to get what they call a line of credit for that same amount. Let's say it's a $500 line of credit. That means that in your bank account, you need to have $500. How does this work? The way it works is you have a credit card that you use and you start making transactions. At the end of the month, it's expected that if you spend $400 out of a $500 credit limit, that you will pay that $400 at the end of the month, so that you can begin accruing a history of successful payments on a month-to-month basis, and creating the confidence within financial institutions that's necessary for them to say, yeah, uh, Johnny here is responsible. You can lend money to him and he will pay it back. If he doesn't pay it back, then we will take the $500 that he put into his account to ensure that we are safeguarding ourselves against a potential delinquency or a potential what they call charge off or loss, right? Once you've successfully shown your responsibility, right, through the means of a secured credit card, what will likely happen is that more banks will be happy to lend you money without, and they will simply trust you more. The way that manifests itself in the context of credit cards is an unsecured credit card. This is the most common kind of card where, you will get a determined amount of money lent, and you can use that money so long as you're able to pay the minimum payment each month. Before issuing a credit card, the majority of credit card companies will review your credit history and your income. And as mentioned, these can be powerful tools that can work to your benefit in order to help you make big purchases and pay them little by little over the course of time. Just checking in. How do you feel about using rewards credit cards to pay for consumers? So I think, Juana, I think maybe in the interest of time, what I'll do is I'll answer these questions towards the end. But thank you. I mean, Stephanie will I'll make sure to share with you my thoughts and answer all questions that we have on the chat. But this is a good question. I can already tell.
Sounds good, Manuel.
Excellent. So, credit cards, secured credit cards, unsecured credit cards, that can be of extreme benefit. Okay. credit cards are the type of things that all adults will tell you to be smart with, right? You hear it all the time. It's cliche. It's beating the dead horse, but it's with good reason, right? They have a very high interest rate, and they can be the kind of slippery slope that will put you in a position where no one will lend you money if you don't do this responsibly. So make sure that you pay your bills on time, never spend your entire credit limit. It's typically encouraged not to have more than 3 active credit cards, particularly mostly for the simple reason that if banks are seeing that you like to have credit cards and you like to spend them and come close to their, you know, to the limit of their line of credit, they might begin to see that you might think they might think that you think that you like free money, and that's not what this is. Credit cards are not free money. They're money that is being lent to you to be able to use. Don't spend more than what you can afford, and if you use it for a long period of time and you show consistency, that gives banks confidence. That's what they like to see. They like to see something, you know, um, boring and consistent. That gives everyone in the financial markets consistency and confidence to let you borrow money. Read your monthly credit card statement carefully. There's a lot there that's important in order to make sure that you're not being overcharged, or that you are not using your credit card incorrectly. Last but not least, if you lose your credit card or if it gets stolen and you detect that someone has been making purchases with your credit card, you need to call your bank immediately and cancel your credit card immediately. By law, the maximum amount that you would have to pay for illegal charges or fraudulent charges against you is $50. So it's a good idea to go ahead and have at your disposal, in the case that you lose your credit card number, your bank or credit card issuer's phone number or hotline, maybe even a photocopy of both sides of your credit card, so that you can help validate in that conversation that you will have with a customer service representative for a bank or financial institution, uh, the right uh, details to help them identify the account and validate you as the correct user of that credit card. And from there, track down potentially who's been using your credit card and who's been spending your money. Excellent. So going back now to your credit score. What is it? Why is it so important? At some point, you've heard of this term, and we'll define it here. Your credit score is a 3-digit number that generally varies between 300 and 850. It represents the probability that you will pay a loan on time. It is calculated based on your credit history. At Latino Community Credit Union, as an example, we don't base our interest rates on our members' credit scores per se, but a high score can definitely be beneficial to you when you're applying for loans at other financial institutions. And we'll explain it in the following example. You have a 2016 Toyota Camry that is worth $23,000, and the banks that will provide the loan to pay that $23,000 will say, sure, we'll give it to you, but you have to pay it back in 66 months. That is the loan term. Further, let's assume you have 2 people that are interested in this car. It's a great car. It's got great reviews, great gas mileage. And you have person A who would like to get that loan for $23,000. Person A has an amazing credit score, 730. They've been paying on time. Person B, on the other hand, has a credit score of 599. How will that credit score play a role in ensuring that both people don't get the same treatment? Person A will receive an interest rate of 1.99, or for simplicity's sake, 2%. Person B will get an interest rate of 15%. That's much higher. What does that how does that manifest itself in terms of dollars? It means that person A will pay a monthly payment of $368, whereas person B is going to pay $513. Add to that the impact of the theory of small things add up. And what that looks like is person A pays a total interest of 1,302 over the course of those 66 months. Person B pays $10,921. Over the course of those 66 months, person A will pay 24,302. Person B will pay 33,921. That's the power of having a good credit score. Person B, for that 23 grand over the course of 66 months, will pay almost $10,000 more than person A by having a credit score of 599, while person A has a credit score of 730. That's why it's important. How's a credit score calculated? It's a number that is, you know, quite complex, and in a lot of different forms on the internet you will hear different theories about what goes into it and what is important to have. But generally speaking, this is what most credit agencies will consider as they calculate your credit score. What goes into it is they look at, 30% of that equation. Your FICO score is calculated based on the following: 30% of it will be based on the amounts that you owe. 35% will be based on your payment history. How successfully have you paid your credit card and all of your loans? 10% will be based on your credit mix, which is otherwise all the different kinds of loans and all the different kinds of credit cards that you might have. 15% is based on the length of your credit history. For how long have you been paying your loans? And last but not least, 10% is based on any new credit that you might have. These are the basic essentials of what goes into cooking that credit score for you. So how can you start building your credit score? So in essence, your credit score and the possibility to have credit is contingent on you being able to identify yourself. A standard form of identification that most people are familiar with is your social security number, or your individual tax identification number. At the Latino Community Credit Union, just as an example, we take both. We take both, right? And I think this is important to share because there may be situations where not everyone is privileged enough or in a position where they can take advantage of a social security number. But there are other ways to identify you as a taxpayer, as a responsible contributor of society and of the financial market. So an ITIN is a perfect, legitimate way to begin identifying yourself for financial institutions. And at the Latino Community Credit, that's precisely what we consider when we began opening up secured credit cards, secured loans, and eventually even mortgages and auto loans. Some of this we discussed already, but the path towards beginning to build your credit history and your credit score often includes a secured credit card. As we discussed earlier, a secured credit card is a great way to start funding your credit. It's the kind of card that if you handle responsibly will boost your credit scores, and most financial institutions have secured credit card options. You then have, you also have a similar concept in secured loans. This is a loan for an amount of equal payments. This amount of money equal to the amount that you would deposit into an account as collateral. Each month, you make payments until you have paid them in full. And when you are finished paying the amount that you originally deposited as collateral, that collateral is returned to you. This is the kind of loan that serves primarily to help you build your credit history so that you can qualify for regular unsecured loans. Financial institutions nationwide will have these kinds of products, and these are the kinds of products that you should look into when you want to establish a path towards building your credit score and your credit history. So we've covered most of everything, and I think hopefully this is beginning to add a whole lot of value to the basic fundamentals that are needed to be financially fit upon graduating. The last step here is to pick the right financial institution. Picking the financial institution that is right for you can be a big decision, and there are a few things that you should consider when making that decision. Most financial institutions can be broken down into two categories. You have banks and you have credit unions. Banks are for-profit financial institutions that are designed to make a profit for shareholders and investors. They offer a range of financial services to their customers, including savings accounts, checkings accounts, and all kinds of loans. A credit union, like Latino Community Credit Union, provides the same, but the difference or big difference here between credit unions and banks is that credit unions are non-for-profit financial institutions that are owned by members of that organization and that are typically designed to empower its members through their financial products and tools. Members of a credit union usually have something in common or a part of a similar group. At LCCU, just as an example, we offer services that are specialized for immigrants and for members of the Latino community. Everyone is welcome to join. You don't have to be of Latino descent to be a member, but we have created a space where Latino immigrants can have access to all of the kinds of financial products that we just mentioned: credit cards, loans, savings accounts, money market accounts, and just about everything that you see on the market. Credit unions are frequently mission based and mission driven. For example, LCCU, our mission is to empower communities and strengthen individuals with ethical financial products and education. Even among credit unions, LCCU is unique in that we are fully member owned. We reinvest all of our assets into our communities in the form of higher interest savings accounts and ethical loans. Our staff is fully bilingual. All of our services are taken into consideration when we have a discussion to inform a particular potential member about what would be best for them. And as mentioned previously, we take not only social security numbers, but we also take individual tax identification numbers. So these are the kinds of things that you should consider when thinking about whether you want to start your path towards financial fitness with a bank or with a credit union. And depending on what your needs are, you can begin to research and find the right financial institution for you. That, I think, covers the entirety of the presentation. I want to thank everyone for their time, and I'm happy to take any questions unless, Juana, you wanted to take the discussion onto other topics?
No, we can definitely answer Stefania's question if you want to touch on that really quickly.
Absolutely. So it says here, how do you feel about using a rewards credit card to pay for consumer debt? I use one for cash incentives for all purchases. That is perfect. Absolutely. So Stefania, I think you're in a position where you are now a more sophisticated user of credit cards. I think my answer is I how I feel about your strategy here. I think it's excellent because some credit cards, and this is again, once you're in a position where you have a reliable credit history, uh, credit score, what financial institutions will do is they will want to provide you with their debt, and they will incentivize it and reward it accordingly. So, in the world of credit cards, you have credit cards that give you points. You have credit cards that give you, as Stefania discusses here, a cash incentive where after using your credit card, say you have a limit of $2,000, um, and you have a good habit of being able to pay that back. As you continue to use that credit card and pay it off successfully at the end of the month, the financial institution might say, hey, for every payment that you make successfully, we're going to give you back 15%, 15% cash back. So now you're spending money, you're paying it back, and the financial institution that's lending you that money is rewarding you for using that money because they want you. Frankly, they would prefer that you are using their credit card as opposed to someone else's. So I think it's a good strategy, and it's a sophisticated way to use short-term debt to not only purchase what it is that you want, but also accrue a little bit of cash on the side. One more question. Why does the credit card increase the limit without you requesting it? I think I think that really depends on the institution. Uh, they should be informing you about anything that's happening with your credit card. It may very well be the case that they are increasing that limit to incentivize you to spend even more money. And again, this is where banks and credit unions are somewhat different. Banks are the types of institutions which are for profit and care about charging you that interest rate. If for whatever reason you missed that payment at the end of the month, the credit card will slap you on the wrist, but at the same time, they'll benefit from charging you that 15% because that's how they make money. Credit union, you don't typically see credit unions put out credit cards that have these kinds of incentives designed to try to make you use the credit card as much, because from a credit union's perspective, what they want is for you to have access to cash from the financial institution that you can use to make a purchase. But they're not particularly hungry or particularly super interested in charging you fees by seeing you spend more than what you really need to spend. Um, the other thing to consider is that right? Banks do like the use of debit cards and credit cards because whenever you use a debit card, say a Mastercard or Visa, Visa pays or splits a fraction of the cost, or rather a fraction of the price that they charge businesses for having access to that debit card. So those are some things again that I think uh, drive credit cards and what you can and how you use them. But again, I approve with that strategy. Here it says I'm in the area WNC where there. Where's
Western
W?
Western North Carolina.
Gotcha. Yeah, I mean, I think it can still be beneficial at the Latino Community Credit Union and at a lot of institutions, but at the Latino Community Credit Union, we have a virtual branch that allows you to open up accounts virtually over the phone. We're now getting into a position where we pretty soon will be able to do loans, mortgages. So my answer to whether it's possible or beneficial to join if you can't physically to go to a location is yes, because a lot of these conversations can happen over the phone. A lot of these documents can be transferred and um, communicated back and forth via email. So if there is an institution that you like and it is within your means to open an account by simply calling that financial institution, then I say go for it. I think uh, we're getting into a point where physical barriers are not as critical to providing access to financial products. Excellent. Next question here, it says, for students who are starting out with a lower credit score, what are some good ways for them to boost it? Also, how important is credit when students are searching for their first job? So, I think a good way to boost them is to contact your local financial institution and ask about what products do they have available to begin boosting your credit score if it's low, or if you have none. A secured credit card, like I mentioned, or a secured loan is or secured loans in general are really good tools to do this because they position you, the individual, as a borrower and the financial institution as a lender in such a way where, again, if you are responsible and you have been saving money, you can use that money that you have saved, put it into an account as collateral, and use that to make a statement. That statement to the bank basically says, "Hey, I don't have a lot of credit or a credit history, but I, I do have the savings to back up my ability to show that I can make payments on a monthly basis." And so when you do that, that's what that's the basically the nature of what a secured credit card is. When you do that, more than likely a bank will be willing to take a bet on you because they'll see, yeah, that person has savings. And if for whatever reason they lie to me, I can take their savings. So it's a mutually beneficial kind of agreement that then allows you to prove as months go by that you are able to pay the credit union or the bank's monthly credit card bill, and then move from there to greater loan amounts with that financial institution as you continuously improve your credit score. Now, is it important? How important is credit when students are searching for their first job? That's a good question. And here, I mean, I can only maybe experience from personal experience. I think when you're looking for a job, they do background checks. They do look at potentially your credit history, and it is feasible, possible that they might see that by virtue of you having a really poor credit score, they might make the assessment slash assumption that maybe you aren't that responsible. So it would be encouraged for you to to the extent that you can to not have a credit score. But again, that's not to say that you will, you know, having a bad credit score will eliminate you from ever getting a job. I think would be my answer to that.
Well, thank you so much, Manuel. We are very grateful for all the wonderful examples and information that you shared. I just want to also remind everyone that the HBCU committee at CFNC has done fourth. So this is our fourth session now. So we did provide a series of webinars, or 4 webinars, I'm sorry, and they are all going to be available on our CFNC YouTube page under the HBCU playlist. And so we invite you all to subscribe to our CFNC page, and we have a lot of other resources. But again, I want to thank Manuel, and I want to thank the Latino Community Credit Union for your collaboration. This was really, really great. Thank you so much.
Excellent. It's my pleasure. Thank you. And please don't hesitate to call us at the credit union for any other thoughts that you might have on how to become financially fit. It's been a pleasure.
Thank you. Have a good evening, everyone.